right, everybody. Welcome to another episode of the Alternative Investor Mastermind. Got a great guest today, Stewart Heath of Harvard Grace Capital. Stewart and I are in a mastermind group together and have got to spend some time together at various conferences. Stewart is a 35-year professional, runs a company called Harvard Grace Capital, which does fractional C-level engagements for businesses. Stewart's also been a real estate investor for more than 20 years with experience in commercial, multifamily development, construction management, and investing. One of the things I really like is Stewart's learned a lot of lessons from 2008, which is something I've also been through, and you kind of only know it if you've lived through it. So gonna have a great episode here. So Stewart, thanks and welcome to the show.
Thanks, Jack. Really appreciate you having me. It's quite the honor.
Yeah. So given where we are in the world economy here, I think I'd like to kind of start talking about how we think this compares to 2008. Maybe if you could just kind of share a little bit of kind of what your experience was with 2008 and how you think this compares over the last 6 months or so.
Yeah. Interesting. It's actually a topic that associates talk about quite a bit. I don't think this looks anything like 2008, 2009. It's hardly comparable at all. That was a 2008. It was a genuine financial crisis that occurred from market conditions of easy credit. And a bunch of people, including yours truly, getting way too much credit that was offered, by banks, and then there was a slowdown. I think Warren Buffett's the one that said, "Now we're going to see who's swimming with their trunks off." Because when the tide went out, everything was flowing back in 2008 because there was lots of credit, and all you needed to do was go get another loan. Asset prices were going up, and so you just went and refinanced the deal you just bought last year, get more money to go buy the next deal, and then it just stopped. It was wiser heads were less foolish, but I was doing everything 100% finance, and banks were all game for it. So that's not really the case here. I would describe our current situation as an artificial economic slowdown. Now, there was going to be an economic slowdown after all the money that flowed into the economy from the pandemic. And when you flood, you couldn't go on vacation. So what did people do? They spent money on their houses. They sold their house. They bought a bigger house. They bought cars. They did all kinds of stuff other than travel. And a lot of that with, free government money. So there was going to be a slowdown. You pulled a lot of demand forward. So we knew things were going to slow down. What's really happening here is the cost of energy. The current administration, put massive restrictions on our ability to generate our own oil and petroleum here in the United States, and that shot up fuel prices. Well, the cost of fuel and energy is built into every product and service, especially food, anything that has to be delivered, and so I call it artificial. It's not artificial to us who are paying $4.50 a gallon at the pump, but to me, it's very reversible by the same stroke of the pen from which this was somewhat caused. Now we have genuine slowdown in the economy because of multiple things. There's no more new free government money. The price of goods is going up. People have, finite resources. We really hadn't seen much happening in the job market, but now we're starting to see that too. I think the world was kind of shaken this week with Walmart's earnings release saying, hey, look, we didn't have such a great quarter, and our customers, Walmart's customers are everyday folks. They are being significantly impacted. And Walmart's is it just about in every business. They're in groceries, they're in consumer products, they're in fuel. They're actually one of the largest fuel distributors in the country. And so now I think artificial triggers are causing a real recession, and I think they may be hard pressed to say it's a recession, but Friday we should find out if we actually have had two quarters of declined economic activity, which would meet the definition. So this to me is nothing like 2008. Most of the people, most of the business didn't do anything to create this one. And the Fed has one tool in its arsenal, and I don't know how raising interest rates is going to do anything about supply chain issues and fuel costs. So that's I think we need policy changes, without going too far down the political side. I mean, both sides do stupid things from time to time. So.
Yeah, absolutely. I mean, I definitely agree that it's 100% different this time. The other key thing that I tend to look back to is, a lot of the residential houses, people got in trouble with these option arms where the rates were locked for a year or two and then doubled in some cases. Whereas
Absolutely.
I think a majority of people in this case locked in 30-year fixed at 2.5-3%.
Right.
And they're not going to be forced to sell. They're locked in at a nice low rate, and those that didn't buy now may end up renting longer, just because the houses are now unaffordable, along with just a lack of overall supply. So, I'd like to think we're much more protected for those of us who focus on multifamily and other niche alternative classes.
Yeah, I think the long-term housing supply outlook is pretty rosy for the housing sector for 10 or 15 years. We got people coming up and they're going to need apartments, they're going to need houses, and we can't keep up. So that's really good if you're on the investment side of housing.
That's great. So tell me more about your path. Like how did you get started into real estate investing? Did you and how did you migrate into syndications?
Excuse me. So I'm a CPA. I think I became a CPA because my dad was a CPA, and he was your very traditional, conservative, stoic kind of a guy, and he was a partner at Ernst and Winnie until the day he retired. It's the only job he ever had out of college was Ernst and Winnie. So, so it sounded good to me, but I'm just a little bit more entrepreneurial than he was. But I'm still a CPA and still do CPA things from time to time. But I've always loved real estate. Very early on, I had an exposure to several clients who were flipping houses before it was called flipping, or they would build a spec house, or and I was just fascinated to learn how they did it. Along about 2001, it's kind of an interesting story. There used to be a guy who had an infomercial on named Carlton Sheets, and I'm sitting there. It's in the middle of tax season, so I'm up at 2:00 in the morning doing tax returns, and his infomercial comes on, and I've probably seen it 100 times, and I just started listening. And it was $199 money back guarantee. I thought, screw it, I'm going to do it. Started reading it, and it was actually pretty good stuff. Well, how do you do this? It was very practical about, and he would tell you how to go through the classified ads back when there were still newspapers, and so I started doing it. And within a few months, I did a seller finance deal on my first duplex, 2001. A month after that, I found another guy who was selling 14 duplexes. And we did a similar thing, and I was able to get mortgage finance on part of it. Got him to take back, seller financing on most of the rest of it. I think I put 10 grand into it, and boom, I was landlord. I had 30 rental units, and just kind of loved it. And from there, partnered up with a guy in Franklin, Tennessee, and started building houses. And we turned some of those into rentals. And from there, I went, still pursuing rentals, ended up buying a small block of condos in one development. And 2 years later, I owned the whole complex, 70 units. And so we're renting them, but that one I wanted to renovate, and condos were just hot. And this was 2006. And so we got those rented, and we brought those back on the market to sell in January of 2007. And I sold 26 of them in the first weekend. It's like, that's great. I'm going to be out of this by Memorial Day. And then the world started to change. In March of that year, it was Lehman Brothers and Bear Stearns started having issues, and I might be off a year there. That might have been 2008. But I didn't sell another one of those condo units for another 12 months. No condo. I mean, we were doing marketing every weekend, so the world sort of stopped. All of those 26 closed, and so the world just slowed down, and all of this was sort of cross collateralized against everything. And so, long story short, in 2008, that was a presidential election. That's when Countrywide Mortgage informed the world on like July the 27th that they couldn't close any of the loans that they had agreed to fund on July the 31st. So that was there were strange times. Anyway, everything came crumbling down, and then ultimately I was able to stay afloat for about 12 more months, and ended up just having to give everything back to the bank. Declared bankruptcy in 2009, and went back and got a job. Never ever lost my passion for real estate, and but the way I'd done it was stupidly. I should have brought in partners. I should have done. I learned the value of equity, of actually having cushion, actually having reserves. After all of that, if I think I had the appraised values of everything I'd put together, and I was partners in some things, was like $20 million of real estate. And if I had even 300,000 of reserves, I'd still have some of those assets. Some of them were worth holding on to for a long, long time. So really learn the value of reserves, and which is something we do now. We build in reserves because you don't know what's going to happen. When you build your empire on asset values always increasing, then you're never prepared for the day when it crashes. Nevertheless, so that's what really led me to syndication. I've had several CFO executive positions in between now, but then in 2017 really came out with Harvard Grace from the consulting side, and in 2020 we formed Harvard Grace Capital. Have partners there. We have closed one deal. We've got two in the works right now, and which should close in October. And reserves, equity, raising capital, most of which we've raised from friends, family, close-in network. Found out about Raise Masters in early 21, joined in April of 21, so, which is just opened a whole. Okay, this is how you do it. How do you reach people? I knew from the Jobs Act and SEC and 506C, I was aware of these type things. I didn't know how you'd go about and find investors. So that's really helped me with that, kind of like what you had said earlier. So that's my story.
That's great. And so what was your first new deal after restarting? Because I know I'm going through what I went through, and I also took a job for a year or two ended up in the non-performing mortgage space, which was
Yeah.
which is an interesting pivot. But I just remember myself, just like the level of anxiety, and I'd somewhat have kind of lost my mojo, if you will, to quote
Totally.
Austin Powers.
Yeah.
So how was the kind of the mental game there, and what was the process to get back and do the first deal post financial crisis?
Well, I would say I regained my mojo. The first job I took was with a guy down in the Huntsville, Alabama area who, he owns things. What does he do for it? Well, he owns stuff. And he develops and he leases, and so and he'd been through something similar in a previous financial crisis, and so he sort of snatched me up pretty quick. So we went out and I helped him structure deals. And so it was almost like going back to school, because I could go out and reprove to myself that I still had the skills and the know-how with somebody else's money. And it's like, all right, so so other than a couple of single family homes that we did, which I hadn't intended to, but they were owned by a lady that I had married along the way. Of course, in the middle of this, there's divorces and then there was a remarriage, which is a fabulous thing. But she'd had some property. I didn't really want to get back into residential, but all right, I know how to do this, so we did those. So the first real deal we did was an office building in Spring Hill, Tennessee, which we actually closed on earlier this year. I had taken on a client. It was a not-for-profit that owned it. They owned this building. They didn't know what to do with it. I said, well, I do. So I managed this building for 3 years, and then I finally convinced them to sell it, which we closed, like I said, in January. So, and a lot of people, in January, if you go back 6 months, people are like, office. Nobody's going back to the office. So, there were a lot of investors who thought, you're crazy. But I mean, I'm in the South. We've kind of pretended there wasn't a pandemic for 2 years. Hardly anybody ever stopped going to the office. Everybody's adopted the hybrid model for sure, but a lot of people were already doing that. So yeah, we bought 100% occupied office building with some expansion capability. So we're in the middle of that deal, and it's going better than expectations. So.
Yeah, that's great. I spend a lot of time thinking about the office market, and it's really two different markets. I was in Napa last week, and Silicon Valley still very, very hybrid. Probably needs a lot less space. At the same time, there's also more people that can work remotely in different parts of the country that may need smaller offices in kind of secondary and tertiary markets. So what were the numbers like? What's your take on the office market as far as how to take advantage of it over the next few years?
I think you just touched on it. There are some stats out there that actually support the fact that all of the movement from population back into downtown areas, that was actually slowing, and in some cities reversing. So when the pandemic hit, we were already in the middle of a trend to go back to suburban office, and that's where our focus is. In the Nashville market and even in the Huntsville market, which are the two markets closest to me, the central business districts are they're healthy, but they're not for office. They're more they've become more entertainment districts. So the office brand in downtown areas is still a bit weak. But you go outside the city centers into the suburbs, and in Nashville and most places, there's hardly any vacancy at all. And I think, I'll speak for the South because I focus on southern cities: Atlanta, Birmingham, Nashville, Huntsville, the Tennessee Valley mainly. So how do you play that? If you can find a good deal on a suburban office property, maybe it needs some work. Work hard and do that deal. We're heavily focused on trying to find medical office, I mean, medical office was never impacted. In some states you couldn't go to your doctor, but all that kind of stuff stopped pretty quickly. But there are lots of office uses that cannot be done remotely. Unless doctors are going to do house calls again, which is unlikely. They're going to have offices, and you're going to have to go see your doctor. So medical offices are huge opportunities, and most of them are full and stay full. And what our deal is, we're pursuing cash flowing assets. You pay a little bit more, but the predictability and the stability of that asset, and so that's what our investor class is looking for, is recurring cash flow, and the ability to do that. What I have found is that there's a lot of properties, and one of them we've put an LOI out on right now, is the visionaries have these. Yeah, let's put an office building there, which took a lot of risk, but then they don't know how to write a good lease. I mean, there's one that we're in right now. It's a great location, but he had no rent escalators in his leases at all, and now all of a sudden we're in inflationary times. You could get away with that for about 20 years, but it's as if you and I are of the age where we remember inflation. We were younger then, but a lot of people really haven't thought much about inflation for 20, 25 years, because it's just been such a non-issue. But I really don't understand anybody who wouldn't put rent escalators in a multi-year lease. All costs continue to go up. I mean, the poor landscapers out there are suffering from gas prices, and they're all having to go up. And as all of your costs go up, and your tenants are going to keep paying the same rent, I mean, it's just, anyway. So there's a lot of opportunities out there from, just call it, poorly managed assets. They might be great assets. So you got to get in there and suffer, but it might take you 2 or 3 years to get all those leases back to a more marketable thing. And then once you've done that, you can then flip that office building, because now you've put the leases into a situation that will keep up with any changes.
Yeah, so I've at least the last few years, been much more focused on multifamily, and I've seen the cap rates compress tremendously, into the threes in some cases. I think we sold the deal in Phoenix at a 3.75 cap. And now with rates moving, we're keeping a close eye on where cap rates are going to stabilize. What does the office market look like as far as entry cap rates, over the last 6 months or a year, or what deals you're looking at now?
Yeah. Last year, they were mostly in the 7s and 8s. Strangely, we closed our deal at a 7.6 cap. Very pleased with that. Since that time, last 6 months, everybody, oh well, people are going back to the office, and again, all real estate's local, but now I think most office properties are in the 5.5 to 6.5 range cap rate. And I don't think they're going to have time to compress like multifamily did. Interest rates are back up. We got a mortgage on the property we closed in January for 10 years, fixed at 3.25. And of course, we knew interest rates were going up at that time, but we had that locked. And now my lock is, and I'm feeling pretty good, is 5.5. Where a lot of banks are at 6.5, even 7. So I don't think there's any room for cap rates to continue to compress. I would expect multifamily they would expand a little bit given the market. So.
Gotcha. And then I know another big thing a lot of our investors look for, and I assume yours as well, is depreciation, especially through the cost segregation.
Absolutely.
What does office generally look like compared to multifamily as far as doing a cost segregation on say $100,000 passive investment? What's the range that investors can perhaps expect in depreciation benefits?
That's a great question. That's going to vary depending on the type of office. If you're going to go to one of these glass and steel concrete structures, you're not going to get a lot of cost segregation, maybe 20% of the purchase price, but the one we did is 28,000 square feet. It was mainly stick construction and stuff like that. So we're expecting about a 35% of the total purchase price to get allocated to personal property assets. And so out of $100,000, they should expect essentially a $35,000 write-off in year one for that. And then, of course, that all depends on how they can use that at their own individual level. But that's what they should expect. I think multifamily runs about 42%, if I'm not mistaken. So.
Yeah, and then so your markets. I mean, I know Nashville has been booming for a while. So Nashville and Huntsville, those are your target markets.
Actually, we've defined our target market as what I call the 840-565 corridor. So there's a loop around southern Nashville, which is I-840, and then there's 565 that goes across northern Alabama. So our focus is in between those two. So I think Nashville's overpriced. I think there's too much competition. We like tertiary markets, and there's good value, good cash flow, and like I say, more stability. And now we're smack in the middle of Huntsville. The other way to refer to is the Tennessee Valley. So Spring Hill, Tennessee, is definitely part of the Nashville MSA, but it's outside of downtown. And like I said, Spring Hill is where GM put the Saturn plant in 1988, and even when they stopped Saturn, they've continued to build other things. And right now, GM is building their EV factory and their battery plant on that same campus. So, and they're about to hire about 10,000 more people, within 2 miles of our facility there. So Spring Hill's not going anywhere. I love the phrase "all real estate is local." I say it all the time. And you really got to get to know your local market. Unfortunately, mortgage rates are sort of nationalized, but real estate opportunities are local. But anyway, there's several great cities where there's manufacturing sectors in southern Middle Tennessee and northern Alabama. Huntsville is just booming. It's all but been officially announced that it will be the center or the base of the new Space Command. There's already been a large military and defense contracting presence there. Toyota Mazda put a new manufacturing plant there and has hired originally 4,000 people, is now hiring 3,000 more. And so all of northern Alabama is to me a fabulous target opportunity for all kinds of assets. We're pursuing a self-storage project right now. I got a contract on that. So.
That's great. I love self-storage. Probably the most recession-resistant asset, because if people do need to downsize, they need a place for their stuff. And really, if people are moving, anytime people are moving, even if they're moving into an area, often time to clean house, get different type of furniture, but they don't want to throw things out. So, love self-storage. So I mean, obviously I assume, mostly real estate like me. What do you dabble in any other alternatives, or where else do you invest your money, if anything?
I got a little money in the market, which frankly I use it as a holding pattern, and I keep it in things like Apple. But I really have not done any crypto. Honestly, I don't understand crypto. It makes me nervous. I've always liked real things. I like dirt. I like brick, mortar, and I enjoy walking around and talking to the tenants and finding out what's going on. There's a reason it's called real estate, because it's real. I don't want to dissuade anybody against crypto. I'm just saying I don't understand it. I've got some friends who've made pretty good money in crypto. It's not done so great this year, but real estate's had its ups and downs in the past too. So I think that there is a future for crypto. ultimately, I think the G7 countries of the world are actually going to end up dominating crypto. It's in one way or the other. There's going to be digital currencies, but I think it's probably going to be dominated by them because the governments are the ones that are most at risk from that type of an asset. So, have been looking at some ETFs, and yes, I'll have to buy some ETH, I believe, to buy a particular ETF. I'm not ETF, NFT. Forgive me. It's some digital art, which I would have never considered, but this one particularly captured my interest. So that's interesting. I think it is a whole brave new world, and so there's just any number of ways that this blockchain technology is going to impact all of our lives, including real estate.
Yeah, I'm fascinated by it, and living down here in Puerto Rico, I'm surrounded by a lot of Bitcoin maximalists, decentralized finance. That's the other thing. There's the NFTs, but then there's also the entire DeFi market, including it's really sort of those that are building it are trying to build it into an alternative financial system. You saw some major issues recently where one of the stable coins collapsed,
right?
But there's a number of other ones that survived, and the crazy thing is they even have certain coins that could actually track stocks. I think there's a protocol called Mirror where you could actually buy synthetic Apple stock using crypto, and there's even some options available. So at the same time, it's very, very much not regulated. I've even seen on some of the pump and dump scams from the 80s of happening with some of these altcoins here too. So it's the Wild West right now, and
it is
keeping an eye on it. But I share your fear, and relative lack of understanding. I know probably just enough to be dangerous.
Yeah, I mean, it's I wouldn't classify it as fear. I'll just say one of the things I've learned is, invest in things and understand, and kind of like my golf game, I've never put the time into it to understand. It's I'm not good at golf because I've never put the time into it. So again, I'm not saying it's evil or bad. I just say it's not something that I do, but I'll find the time at the appropriate time.
Yeah,
but I'm not surprised that there's scams. There's one of my sons showed me this thing. He was trying to sell a laptop on Venmo the other day, and he got this email back saying that you need to send the seller back $350, and he's like, I haven't even got his money yet, and this is the same old scam from 30 years ago, just applied to the new digital platform. So there's nothing new under the sun.
Yeah, and those of us that have had some success too, it's we don't need home runs anymore. I want you mentioned cash flowing assets, so 80 to 90% of what I do, I just focus on principal protection and cash flow. I don't need the 100x return, and I have a little bit of money in venture. And a few venture funds, because if you're going to do venture, you really should be in 20 different projects as opposed to one, unless you really,
because 19 of them are going to fail. So,
exactly. So you need diversification. So what advice do you have for people just getting started into alternative investments?
Well, first, I take issue with applying real estate to with a term called alternative investments. Wall Street has done a great job of calling real estate alternative. I like to refer to real estate as the original investment. I mean, it's been around since the beginning of time. So anyway, that's just
I like it.
Soapbox. It's my little soapbox. First, for people getting started, first decide how you want to be involved, and sometimes it's hard to know. Do you want to be on the capital raising side, or do you want to do like I do? I enjoy managing the properties, and I guess I would call that the asset management. So we do work with property managers from time to time, depending on the property. But I enjoy, essentially running the asset. And if that's something that you enjoy, get involved in that side. But if you like, if you're more salesy and think you could get involved in the capital raising side, then follow Jack and I and join Raise Masters and learn what that's all about. Real estate's not complicated, so it's not a very difficult business to learn. And so if you've got the skills to raise capital, you can apply that to almost any industry out there. So first, understand what really interests you. I would say start small, because you can get the same amount of education on a small transaction than you can a big transaction, although your mistakes will be small. And so never ever question the benefits of actual equity in the asset. It's the hard lesson learned. So the late 2000s, it was just everything just been going up and up and up and up since 2001. And it's like, why would things turn around? Well, they do. So, and a lot of times for reasons outside of your control and for nothing that you did. So
that's great stuff. That's great stuff. How do we get a hold of you?
Best way to get a hold of me is harvardgracecapital.com. It's all spelled out. There you can find a link to my Calendly. I would love to talk with anybody who would like to have a conversation. I can talk real estate and investments all day long. So you're welcome to go out there and grab some time. My email's there, my phone number's there. That's the best way to get me. So.
That's great. And we'll put that in the show notes as well.
Thank you.
Stewart, really great conversation. Thank you again for coming on the show. Really great stuff. I'm gonna keep this that with me, that real estate's not an alternative asset. It's the original assit.
It's the original
I really
asset.
Like that. I like that a lot. But
I'm going to trademark it. You'll have to pay me a quarter every time.
Right, I'll give you royalties, and I'll pay you royalties and beers at future conferences.
You got it. It.
Well, thanks again for being on the show, and encourage everyone to please subscribe to us on iTunes, Spotify, your platform of choice. Subscribe to us on YouTube. Give us a thumbs up, and thanks again for listening to the show, everybody.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.